Good afternoon. We are looking at the corporate finance for the previous quiz that was done some time back. Okay. So getting down to the first question of this quiz, the question one reads, a business formed by two or more individuals who each have unlimited liability for all of the firm's business debt is called. So the answer there is C. And a partnership is a business that is formed by two or more people. So it's a general partnership. So the answer is C on that one. Then, which of the following terms is defined as a conflict of interest between the corporate shareholders and the corporate managers? So there is the aspect of urgency problem. That is the answer there for question 2. So it's the urgency problem. And again, on question 3, a business partner whose potential financial loss in the partnership will not exceed his or her investment in that partnership is just a limited partner. That is on question number 3. Okay, so these are the theoretical ones, this corporate finance quiz that came. Then the interest paid depend on the original principal borrowed is just a simple interest. And the simple interest is actually equal to principal multiplied by the rate. Of course, so multiplied by the rate, then multiplied by the time. Then you divide this by 100. So what we are simply saying is that on our SI, the simple interest is equal to the principal multiplied by the rate, then multiplied by the time. Then after this, we divide by 100. Okay, so this is on how this one operates. Then getting down to the other question here of this quiz, we can look at question 6 for now. All these other questions, we are going to do them. So what's the present value of 1,000? So the present value of 1,000 will be navigating as we are answering these questions. So what's the present value of 1,000? Annuity, which is another annuity, but it has no infinite number of periods. So it's this is a perpetuity. A perpetuity is a continuous cash flow. So when you're talking about perpetuity, this is a continuous cash flow. Okay, it has infinite time, so it's continuous. Cash flow. Okay, and then how we find the value of perpetuity is equal to amount of cash flow, A, which is amount of cash flow. Then we divide by the interest rate. So this is on how you get this perpetuity. So amount of cash flow, amount of cash flow. Then you divide by the interest rate. So what is going to happen here is that when we come here, the present value for this one is actually going to give us the 1,000. Then you divide this one by the 0.08, which is actually giving us the 12,500. So this is about the amount of this perpetuity. All right, so the answer is C on this one. All right, so this is on how we find so this one, question 6. Okay, and then of course an annuity is a series of equal deposit or equal payments. That is an annuity. Of course, we have ordinary annuity. Of course, this means we have covered already in the other class. So we have an ordinary annuity. If we additional to that, so ordinary annuity, we know this is a payment of the same amount made at the end of each period. So the present value of this ordinary, the formulas are given. So it's amount, then you simply say 1 minus 1 plus R, then to the power negative N over R. So if you ask if you have anything else in addition to that one. Now, perpetuity is a continuous one. So that's why the formula was then the future value of this ordinary annuity where payments are made, payments of the same amount. If it's a 1,000, you're making a deposit towards your saving at the end of every month or at the end of every year, you're saving a 1,000. That becomes an ordinary annuity because the equal payments are being made at the end of the period. So it's called an ordinary annuity. So the future value of ordinary annuity is given by these formulas. These formulas, they are given. So this is for ordinary annuity, future value, present value is that one on top there. All right, so now we can build up a little bit. So I'll be giving additions to a question as we're looking at the question from this quiz. So Which of the following is not an agent's cost? Okay, so the answer there is C, where we're saying increasing a quarterly dividend. It is an agent's cost. Okay, so these other ones, they do not form part of the agent's costs. Okay, now I want us to look at so this one is done. These are the other questions that we are not doing. We'll come back to them at another time. Okay, we are navigating. So of course, this other one, we'll come back to it. I want us to go to exhaust on let's check out question 11 for now. Okay. Assume that the interest rate is greater than 0. For question 7, let's go to question 11. Assume that the interest rate is greater than 0. So we can give an interest rate greater than 0, meaning that you can even pick anything like 5%. Let's take it at 5%. So when we take it at 5%, which of the following cash flow streams totaling 1.5 would you prefer? Can we go for any of the above, or can we go for B? If we go for B, an example, B, we have a 500. So if you want to find the present value, okay, for year 1, it will be 500. If we take the interest rate, what does the first one says, if let's say we take the rate, any rate greater than 0, so take rate equal to 5%. So which of them can we prefer for year 1? An example, we have a 500. We want to find the present value. So be 500. The present value we deposit, present value is equal to future value, then 1 plus R to the power negative N. So this is how I find the present value. So if you get a 500 there, then R is 5%, so it will give us 1.05 to the power negative 1. What happens there? So that example there, we can say 500, open brackets, 1.05 to the power negative 1 will be 470 what? 476. Okay, 0.19. Then what happens with year 2? Year 2, we are using the same, it says 500 throughout to total 1.5. So this is the 500. Then 1.05 to the power negative 2. We can get the value there. 500, 1.05 to the power negative 2 is 453. So 453. Point what? 0.5. Then if we are to go for year 3, it will be what? 500. 500. 1.05 to the power negative 3. We can find that one. 500, 1.05 to the power negative 3 is giving us 431. So 431.9. Now, when we add these ones, what will be a total? Okay, so we are simply saying which one can we prefer. So there, when we add those 476.19 plus 453.5 plus 431.9, it's giving us 1361.59. So now, when we go back to the question, you can see that which one can we prefer for you to total? Can we go for the 500 throughout, but for interest rate greater than 0? So we had to use the interest rate of 5%. We chose 5%, or you can choose any percentage that is greater than 0, even 1% or so. So what happens is the answer should be D. Why? Because the reason why the answer should be this one is because these streams, they're totaling 1,500. 700 plus 500 is 1, 2. Then plus a 300 will give us a what? Will give us 1, 5. Now, why are we going for this? We've gone for this one. It's because as we can see, the first one is 700. We multiply by, we chose the 0.5%, which will give us, so we can we can sort out that one. So meaning here we have said, yeah, other option here is giving us this. If you had to go 500, 500, it is giving us this. Now, if you are to go this way, here 700, let's find the present. Let's find the, there's a question. So it's 700, 1.05 to the power -1. Then let's go for year 2. It says 500, then 1.05, so that we see which one will be better. -2. Then year 3, we are going to have 300. That is what was given, part of the answers. 1.05 to the power -3. So meaning that 700 there, 1.05 to the power -1. So we are getting, this one is 6, 6, 6, then point what? 0.7. Then the other one is 500, 1.05 to the power -2, 453, 453.5. Then the other one is 300, 1.05 to the power -3 is 259, 259.15. So let us sum up these ones to see what we are going to get. 66.7 plus 453.5 plus 259.15. So it's giving us 13 what? 1379.35. That's the total present value. So when we compare this one and the other one we found was 1361. So meaning this will give us the higher present value than the other one. So this is the reason why we have actually selected this one here. Okay. Even if we were to go for C, this is better because the first one for C was 300, and then the other one was 500 and the 700. This one we can prove it, confirm it. For the other one, year one, if you are going to go for that one, year one is 300. Then 1.05 to the power what? -1. Then year two, you are simply saying 500 then 1.05 to the power -2. Then the other one is just 3. Is what? 700. 1.05 to the power -3. What answers are we getting? And then let's find the total here so that we see which one will be better. 300, 1.05 to the power -1 is 280 what? 285.17. Then the other one is what? 500. 1.05 to the power -2. Fourth is what? 453.5. Then the other one, 700, 1.05 to the power -3. 604. Okay, so 604.7. So 285.17 plus 453.5 plus 604.7. So it's giving us what? 1343.4. So meaning if we compare this one here, then we also compare the other one, and then this other one here. So the highest of these ones is 1379. So this is why we are simply saying that the answer we should go for is this one. Yeah, so here, question 12, time value of money is where we are looking at the aspect of interest rate. Money today is better than money tomorrow because of the interest rate, okay? Because the money can depreciate, the currency can depreciate, all right? So the currency can depreciate, so the rate of interest is used to express time value of money, which is true. Okay, so there is aspect of interest rate as we are looking at time value of money. So time value of money means we are accounting for interest rate. account. Okay, so this one, account for interest rate. So this is about the aspect of the time value of what? Of money. All right, so this is only that aspect. So we'll be actually navigating to check on whatever it is that we are doing here. It's a previous quiz that was done sometime. The shareholder A sold 500 shares of ABIS on the Ruse. This transaction, it was done in the secondary market, not the primary market. Okay, so primary markets are called IOP, initial public offer. So these are primary. This is where we are talking about primary market. IOP means initial public offer. So this one is initial public offer. Is what we call the primary market. So the answer is C. So this is not for the initial. The sale of shares is not for the initial public offer. So it's transacted in the secondary market after the primary market. So it is in the secondary market where you're talking about the issue of the shares. Okay, when the shares are being sold. Then one-man business is called a sole trader. Sole trader is a business that is taken by an individual when you set up your own. Okay, a sole trader enjoys profits alone and suffers losses alone, and the business dies when the owner dies, because it's a sole business. Solitary simply means one. A solitary individual simply means one person. Two or more people, it's a partnership. So this is a sole proprietorship is on the aspect of one-man business. Okay. So this is on one-man business is a sole proprietorship. Okay. So this is what goes on. All right. So this is it on question 11, question 12. Then we're getting down to question 13, 14. Okay. So you actually come back to question 15. Let's move on a bit. Okay, now here we are on question. Let's take out question for this bank XP is 5.6 compounded daily based on 365 days on a 9-month certificate of deposit. Then we deposited how much? If you deposit 20,000, you would expect to earn around how much interest? So let us check what is going to have there on the daily compounding. Future value is equal to present value. Then 1 plus R divided by 360. Then, all right, then 360 to the power n. In fact, they are saying 360 based on 360 days in this case. 360 to the power n. So on a 9-month deposit, all right, so meaning that we can sort out this one. Let's find the answer for the future value. So future value is equal to present, which is 20,000. The interest rate was at 5.6. So 5.6 divided by 100. Then divide by 360 plus 1. Okay. In fact, now there we are not going to divide by 360, we'll divide by 270. Yeah, so 5.6 divided by 100 divided by 270. I'll explain the reason why we are going to divide by 270. It's just because of the fact that it was a 9-month. So multiply 30 days per month, then multiplied by 9 months. Okay. Then we multiply by 20,000. So this one, we'll come to this now where we say our future value is equal to present value 1 plus R over 270 in this case. Then 270 n. So what I was simply saying is 9 months. Okay, so 9 months, we are going to have 9 multiplied by 30 days per month. 30 days per month. Right, so meaning that what is going to happen here is we are going to have 9 by 30 is 270 days. So you're simply saying our future value is actually going to be 20,000. Then 1 plus 5.6. No, this is it. 5.6 divided by 100 is the same as 0.0 what? 56. 0.056 over 270. Okay, then 270 again here. This is the power 270. So it's giving us what? Our future value is actually going to be 20,000 or 20,000 here. Then on 1.000207407 to the power 270. So the power 270 and multiply by 20,000. So it's giving us 21. So to give us a 151.8. So approximately the interest that will be here. So this is the this is the future value. Now interest we say need to subtract those two. Or interest will give us 151 point this minus 20. So it's about 151. So an example here on this one now, the approximate answer here should be 112. This one is the closest possible. This would have been the answer there. Okay, let's move on to the other question. Okay, so what we're following best describes the primary advantage of being a limited partner instead of a general. So you're talking about a maximum loss limited to the capital invested. So the primary advantage of being a limited partner instead of a general partner is the maximum loss limited to the capital invested. So it will depend on the amount of capital that was invested there. The maximum loss limited to the capital that is invested. Okay. So now a business created as a distinct legal entity and treated as legal person is called just a corporation, just a company. It's a corporation. Then I want us to look at the other one first. We'll come to these ones. So we go to, if we go to question 22, so that we go on and fill up the other ones now. With a continuous compounding of 8% for 20 years, what is the approximate future value of this? So the future value of a continuous compounding, future value is equal to present value, then multiply by exponential to the power RT. RT, that's the formula for the future value continuous compounding. So our future value of this continuous compounding is actually going to be, our present value is 20,000. Okay, so present value is 20,000 from there. Then exponential, the 0.08. So 0.08 multiplied by the time period is 20. So what are we getting here? Our future value will be equal to, of this continuous compounding formula, you just need to know it. So it's 20,000. Okay, then E to the power 0.08 by 20, which is 1.6. 1.6. 1.6 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 × 20 Okay, 1 point what? So the answer will give us what? So we can use a calculator. 20,000 multiplied by shift, press one shift, and natural log 1.6. It's giving us 99. 99, that's the answer. 99 0 6 0 0.64. So when you round off this one, the answer is just that one there on the continuous what? Compounding. All right. So this is about what goes on here. Okay. So let us get into question 21 now. You want to have 1 million when you retire in 30 years. So when you retire in 30 years, we want to have that. You expect to earn 12% compounded monthly over the entire 30 years period. How much extra money per month must you deposit if you choose a fund using an ordinary annuity technique? Okay, ordinary annuity technique rather than an annuity due technique. So here we are talking about ordinary annuity, future value formula. Annuity is equal to amount of that equal deposit, then 1 plus, okay, we need to have 1 million. So that is the future value annuity ordinary. So n minus 1 over r. This is when it is annual compounding. Now the question here says compounded monthly, okay, for the entire 30-year period. So what are we given here? We are given the future value annuity, and of course we have so from here the workings we can do. So we have future value of an annuity for monthly, it will be amount. All right, then 1 plus r divided by 12 months to the power n by 12, then minus 1 over r divided by 12. All right, so now we want to have a 1 million. So future value here in the question, it's 1 million. So this 1 million was given. So how much of the deposit that we are going to make each month for you to have this much in 30 years? So rate is what? 1 plus the rate there, we know it is 0.12 over 12. All right. Then whatever we are doing here, we simply say 30 by 12, then minus 1 over 0.12 over 12. That's all. So meaning that the 12% was given in the question. So meaning that we are going to have now our 1 million, which is equal to now amount. We don't know is what we are looking for. Then here to give us, as we sort out that 0.12 divided by 12, then plus 1 is 1 point what? 1.01. Then to the power what? 30 times 12 is 360. So 360 here. Then minus 1 over 0.12 divided by 12 is actually 0.01. So as we say 1.01 to the power 360. Okay, then minus 1. Then after that, you divide by 0.01. It's giving us what? It's giving us 3494.964, and we have A there. Then we have our 1 million here. So we are dividing this by 3494.964. Even here by 3494.964. So that and that goes. So we are going to have our amount. $286 286.12. So this is about the answer that we need to go for. 286 points. So the answer is this one is the correct answer. 286.13. After getting this, answer is B. 286.13. All right, so it is 286.13. So it's 125. So it is 286.13 is equal to amount. So this is just about the way to go for this one. All right. So all other things, okay. A mortgage banker is a financial institution that underwrites new. This is false. Okay. So we have this one here. So in 2 years, you are to receive 10,000. If the interest rate were to suddenly decrease, okay, the present value of the future amount would rise. Okay, if you are to receive this, the present, so meaning if this one, the way I answer is this: if you are to receive this one in 2 years, so like 10,000, then what happens is that if the interest rate was 10%, which is present value we know is equal to future value, all right? Then 1 plus r to the power negative n. So meaning that if it was 10% the initial interest, 1.1 to the power negative 2, then our present value is actually going to give us what? 10,000, 1.1 to the power negative 2. So we would have gotten the 8,264. All right. Then 0.5. So if the interest rate falls from 10%, let's say it goes to 5%, so it will be like 10,000. So any decrease, it's a practical one. You can give yourself the rates that are practical. So if it changes to 5%, so it will be 1.05 to the power negative 2. Our present value is actually going to give us 1.05 to the power negative 2. So we are simply getting 9070.3. So this is what explains this point, equation 19, that in 2 years you are to receive 10,000. If the interest rate decrease, then the present value would actually increase, to rise. All right, so these are the calculations that we have here. Okay. So, okay. So, now here, if we have to go to question 25, the future value is equal to present value, then 1 plus r to the power n. So here we had, if you want to double the amount, let's say you had the 1,000, then it goes to 2,000. Okay, in 6 years. So 1 plus r to the power 6 here. So divide by 1,000 here. Let's find the rate. Let's find the rate here to see if it will give us the 12%, then that is true. So what we are simply saying now here is that doubling that amount, so it will be 2 is equal to, when we divide, okay, we had the 2,000. 2,000, how much did we put? We had put the 1,000. Then 1 plus raised to the power 6. So we divide by 1,000, divide by 1,000. So our 2 is actually going to be 1 plus r to the power 6 here. So what do? You multiply by 1/6 to get rid of that. Even here, you multiply this one by 1/6, so that this one and this one goes. So 2 to the power 1 divided by 6. So this one is giving us 1.12246 is equal to 1 plus R. Then 1.12246 minus 1 is equal to R. So what are we saying here? Now here we are simply saying that minus 1, so it's 0.122, 0.122 is equal to R. So this is 12.2% is equal to our R. So that is what goes on. So meaning that the answer is true. Okay, so the answer is true, that this will give us, from the workings, that this will give us our rate equal to 12%. So this is about what this one goes. All right, so this is on how this quiz was done. So then the other aspects there is look at to increase again future value, the discount rate should be downward. Yes, to increase the future value, the discount rate should be actually adjusted downward, which is true. So if I were to increase the future value, the discount rate should be adjusted downwards. As we can see here, future value is equal to present value. All right, then 1 plus R to the power n. So if we adjust downwards the discount rate, R is the discount rate. So our future value is actually present value. If we had, let's say, 5,000, okay, or even 500 for so to speak, then at 8%, in the initial one, if it was 8%, and let's say for 2 years, meaning that the 500, 1.08 to the power negative to the power 2. So we are simply saying 5, it will give us 583. Now, what happens if the discount rate goes down? Okay, if we want to increase the future value, what happens now here is that our future value, when we adjust the discount rate to, instead of 8%, let's go for 2%. So let's go for 2%, which is 1.02. So the lower the discount rate, the higher the value. The lower the discount rate, the higher the value. So 1.02 to the power 2 is giving us, okay, we are simply getting that. Let's see. To increase the future value, no, the answer should be not that. The answer should be D, because this value is actually giving us the lower rate to the power 2. So it's actually 520. So meaning the answer is D instead. So to increase the future value, the discount rate should be adjusted upward. So the answer should be this one has failed, because from the practice here, from the real calculations here, so the answer is giving us, this is our answer to go, because you can test this using the actual figures. Okay. Then the primary goal of financial management is just to maximize the share price, the value, the current value per share for wealth maximization. Okay, so this is it to maximize the current value per share. All right, so this is the primary goal of financial management. So here from these calculations, we are able to see, to read that you're proving the answers that are here. So this answer was B from the calculations. Then here the answer should be actually should be D. Okay, so that's the answer there from the calculations that we've seen. Then the answer for question 24, maximize the current value per share. Then here we've proven that the annual return for 6 years, when this doubles, the amount doubles in 6 years, it is approximately 12%, for which we calculated on this one. So this is about how this quiz was done. So it's just a matter of time getting down to the solutions. Some of these, a lot of them have calculated them. So just the aspect of actually getting down to the questions that we have actually looked at. So it's just a matter of going through them. Then you'll be able to check for the solutions that we've given to you on this one. Okay, for anything else that we've actually sorted out. So these are the questions that we've looked at. During question 11, we proved this one, going through the breakdown of having the total of 1,500. This one on question 11, we actually sorted out on that aspect, on making comparisons among these ones to look at which one the streams that we total to 1,500 on. This was question 11. So unless there are questions so far on what we have actually looked at so far, so just take time to go through these ones according to whatever it is that we have looked at together. Unless there are questions, but we can end the class for now. Make sure you have time to go through all these ones. The workings are done. Maybe in question 21, the workings we have done on that one. Okay. For the 286, this was question what? This was question 21, where we got the 286 on this ordinary annuity technique instead of an annuity due. Annuity due is where payments or deposits are made at the beginning of each period. So this was on question number 21. Workings on question 21. So question 21, the working is here. Just need to actually go through and understand them. Even on the continuous compounding, question 22 was on continuous compounding. Then question 23, we're trying to prove what happens to the discount rate for you to increase the future value. So the interest rate should be adjusted upwards because we have compared here. If the rate is 1.08, we got 583. And then here, future value is 520. So meaning for you to have an increase in future value, should adjust the rate upwards. Okay, and getting down to question 25 is there for us to get the what? All right. All right, so this is about what we have on this one. Unless if there are any other questions, you can ask questions for any clarity that you need. You can ask questions.
Hi, Collins. Hi.
Yes, please.
Can you get me?
Yes.
Okay. Yeah. I joined a little bit late. Do you have the whole presentation available
Yes.
for review?
Yes, for review, I think it will be shared with you. I think Mr. Collins will actually share with you on these other ones that you missed, so that you can also follow through.
Okay. And then, okay, maybe let me settle this with Collins. I had one or two other questions.
Okay.
But let me settle it with Collins.
Okay. Is it what to do with this same work, or it was something else?
No, something else. Something else,
Okay.
because I think this is my first session.
Uh-huh.
Yeah, so I wanted to just see how this can be normalized.
Oh, okay, no problem, no problem. You just share, sort out that with him. There's no problem.
All right.
This will be shared. This will be shared with you. Or anything you missed,
All right.
sure will be the recording was done, so you'll be able to follow through.
All right. Thank you.
You're welcome.